Hey guys, Nick Supik, Century 21 here with my buddy John Kearney and with Victorian Finance. And so we're here just in the back office. We're going to call this a little back office interview, right? You know, so we're going to kind of talk about some cause and effect of the real estate market, the mortgage market, interest rates, just what happened over the last few years, how we got to where we are, and then kind of where we're going we can't really tell the future, but we can kind of talk a little bit about where some things are going to go with the government talking about interest rates and how things just happen in our industry. I got over 15 years of experience, and John, how?
I've been doing it since 2008.
Okay, so we got a lot of experience here. We got over 30 years of experience sitting here. And I know the Bible says in Proverbs that surround yourself with wise counsel, and that's why I brought this guy in. He's got wise counsel for me, so I'm grateful for that. And just real quick, we had talked over before, COVID back in 2020. Things just kind of really went bonkers. It went crazy, and it was rates were low, prices kind of went crazy, and then so we were talking. We noticed.
So if you think about this, going in from 2019 into 2020, the Federal Reserve was actually raising prime at that point.
Okay.
What ended up happening, though, is in February when COVID started becoming prevalent and all the unknowns and all that stuff, in March is when they really started shutting everything down. So people were like losing their jobs or getting furloughed or getting put on unemployment left and right. So what ended up happening is a lot of those transactions in that March period just stopped. So like like what we were talking about, like a dam just formed where transactions just completely stopped because everything was getting shut down. And actually at that particular point in time, rates were fluctuating crazy. They were increasing because of the uncertainty.
So rates were fluctuating back in
2020, early 2020, in late 2019, because the Federal Reserve was raising prime in 2018 and 2019. So what ended up happening was the investors the secondary market was increasing their interest rates because of all the uncertainty with COVID. But then in turn, what ended up happening is the Federal Reserve made a decision, I believe in May, that there was talks where they took the Fed's funds rates down to zero immediately. Okay. So they just dropped it all the way back to zero.
So that makes money cheap?
That makes money cheaper because the Fed funds rate is what banks borrow money at, or institutions borrow money at. So when they're borrowing it at zero, that margin for profit is passed on to the client. Obviously, there's a margin that the banks and everybody has to make money, but that
wasn't it like in the negative at one point?
Yeah. Well, how it works is like it's called the real interest rate. The real interest rate takes inflation and the Fed's funds rate and basically adds it or subtracts it. So when you have inflation at 9%, and you have the Fed's funds rate at zero, the real interest rate to the consumer is actually a negative 9%.
Wow.
So that's not what you're borrowing, but that's just basically the real interest rate to the consumer because you think that they have investments.
That was in 2020, so it was a negative 9%.
Well, no. So the thing is in 2020 we didn't have the inflation problem that we did.
Right,
okay. Right. So when we're talking about inflation, think about this. In 2008, when we had the financial crisis where the banks started getting bailed out, you had Wachovia that turned into Wells Fargo and stuff like that. The federal government implemented $1 trillion in assistance to bail those places, to bail everybody out.
Yeah.
They were worried in 2008 that it was going to be inflationary. They were really, really concerned about that when they were passing all these bills. In 2020, during COVID, we distributed $8 trillion.
Wow.
So think about that. They were worried in 2008 that it was going to create inflation at $1 trillion. We did $8 trillion. Yeah. So if you think about it, we've had an inverted yield for almost, I believe it's like 22 months, almost 2 years. Inverted yield is where short-term interest rates are higher than long-term interest rates. So what that means is normally when an inverted yield occurs, a recession is inevitable within the next 6 to 12 to 24 months, but there's really no time frame on that. The problem is that we distributed so much government funding during COVID to get the money, to tighten the money supply, to pull that money back that we distributed is taking a lot longer than ever because we've never distributed that much government funding, $8 trillion.
There's no protocol for that, right?
There's no protocol. There's no time frame on it. So now what we're seeing, though, is we're seeing the crest in the curve, if you want to, quote unquote, for the graph with the interest rates. Interest rates peaked October 26th of 23, the highest they have ever have been
When
in the
was
last.
that again?
October 26th of 2023 is where they were the highest they were.
So a few months ago. Okay.
But now they're on their way back down.
So that kind of, so to step back for a second, so I know we were talking off camera about in 2022. So it was like the winter of 22, spring. Like we all knew things were just happening. Like, you know, that market that was just going like this somehow started to hit the top of the mountain, if you would. And like what I knew, I was in different mentor groups and stuff, and we were all going, hey, you go, you, everybody's going, yeah, you know, and this was like February, March, and then it was like, oh yeah, pendings, which is a number. Like we can track pendings like from every month. Hey, how many homes are under contract at any given time? And that was the first time since COVID that it actually decreased. It was constantly on an increase, and it finally decreased. And it was like, uh-oh. And you were just mentioning about how you guys noticed that jobs and things were changing. You know, the loans were changing for you guys.
Yes, and
in what, April, March?
So are you talking in 2022?
22. Yeah.
Okay, in 22, yes, because when you were doing like market analysis and everything was showing that rates were going to continue to climb. Okay, we didn't know how long that was going to be and all that. So what that did was that created consumer uncertainty because they were like, okay, or it made people like, well, we got to act now. So in turn, what you had is you had people go sit on the sidelines because they were like, we're not going to go through this. But still in 2022, because you had a lot more volume in 22.
Well, rates hadn't really gone up yet in that 22 time.
Yeah,
early 22.
Yeah, and it basically took until in 2022, the rates reached their peak in, I believe it was August or September of that year. Mm-hmm. And then they started to come down a little bit because there were some projections that we're going to see the Fed pause or all that, but that didn't happen, as we all know, in 2023. So actually, 2022 was a higher volume year than 2023.
Right. So then going into 23, so this year we just had, the beginning of the year, like home prices hadn't really, it hadn't affected home prices yet.
Well, it takes time, too, to trickle that through. But here's the thing is that we're still seeing that the property still appreciated in value in 2023, even with the increased interest rates. What never went negative, all we saw was a deceleration in appreciation. So that was the biggest thing that people were always thinking, well, am I going to not... if I'm going to buy this at $300,000, is it going to be worth $275 in a year? It's like, no, home's still appreciated in value. You're just not going to see double-digit appreciation like we were seeing.
Right.
Like you're seeing, 30 and 40 offers on a house go $80,000, $100,000 over asking. Like that's what really drove up the appreciation numbers. Yeah,
and I do a weekly market report that I just kind of do internally, and then I do post it on my website, and we call it Smart News. But so going back to early 23, like again, home prices had continually appreciated every month except beginning of the year. And then I think it was the first quarter and into second quarter we did have a decrease in interest.
But if you think about it, that's the slow time of the year too. So and normally at the beginning of every year, rates will kind of come down a little bit because it's a slow time, happens every year. That in 2023 it did not happen. They just kept going up. And it had everything to do with the hawkish position of the Federal Reserve with the Fed funds rate because they were bound to get everything under control, inflation under control. So now it moved forward for a year. We are definitely getting inflation under control. CPI report comes out today. I didn't get a chance to look at what the CPI report was, but that's the Consumer Price Index. So that being said, they're seeing inflation get under control. So we've hit the crest of the highest rates we're going to see. So they're going to start now to come down and stabilize. And then we're looking at the Fed funds rate should start getting cut.
But inflation's still not where they want it to be.
No.
I understand it's in that 4.5.
The problem is that it's kind of like when you get into a car accident. It's like you have to crash and then you pull the wheel. It's like we trying not to crash the car and have to pull the wheel. We're trying to just like avoid the crash. Like it is coming down. We are seeing the economy slow, And we're also seeing like home prices stabilize. I've been seeing, price cuts on properties and stuff like that. So we are starting to see that. So they're not going to try. So they have paused the last 2 rate hikes, like decisions. They've paused it. And
in the last, November, December?
Yes.
Okay.
Yeah. So now we're going to see them really look at the numbers, see where the inflation numbers are going. We actually had a pretty decent jobs report last week. It showed that we had a bunch of jobs creations, but after you rip through the numbers, it was minuscule by any means. And then also too,
But it's not a decline, at least?
no, it's not. It wasn't a decline by any means, but it wasn't massive growth either, is what they're trying to avoid.
So if we go back to, we had this huge, in COVID, it went up, and then we're coming down 22, 23, but we're here. We're kind of leveled out again?
Yeah, so if you think about, like that,
Yeah.
you think of the interest rate charts other way. So, you had the rates down here, and now
They went up.
October.
So we're again leveled off again.
Now they're on their way back down. So it's a nice thing now too, though, is you're in a nice, I call it a softening in the real estate market, where it hasn't trickled through everything yet, so you can still try to get a deal and you're not competing. I will tell you this, when the Fed starts cutting interest rates, you're going to start seeing a lot more competitive offers, a lot more competitive properties, because affordability starts becoming, homes become more affordable when rates go down and prices stabilize. That's the biggest thing. I will say that is the biggest factor that we dealt with the last 6 to 8 months was affordability.
Okay.
And that's another reason too, as I was talking, is that we still have 4.5 million first-time home buyers between the age of 45 and 55. I mean, 25 and 45 years old that are looking to purchase homes. It's not like they bought a home; they have just been waiting.
They've been wanting to buy for the last couple of years.
So here's how it works in our business: is that everything's transactional. You have transactions, but obviously you try to build relationships and all that. But when we're talking about specific transactions, those transactions are coming. It's just there's pent-up demand waiting for those to come to fruition into closings and pending, like all the sales that we're talking about. Those people didn't go anywhere. They're still looking for homes. It's just they haven't bought a home yet. They're sitting waiting for the market to stabilize. That's the biggest thing that we need. So those transactions are there. It's just, is 2024 going to be a huge year? Is it going to be 2025? Or is this just going to be more of a slower increase? But I think that we've reached the peak of the interest rate graph and the peak of the bottom of the real estate transaction base.
And some of that's driven, low inventory. When we say low inventory, it means there's just not a lot of homes available. And so if you have a home, you probably want to put on the market because there's not a lot of competition out there. And so there's just not available for first-time home buyers. They were kind of stuck not being able to compete in those competitive markets the last few years. This is kind of giving them an opportunity now.
Yes, and the rates are coming down where affordability is getting better. And that was another thing, is you had competitiveness that happened, but then you had
high interest rate.
Then you had is it feasible for me to buy the home because of the interest rate and the monthly payment? So that's what's affordability is getting. We're getting back to the affordability, so we should get a lot more people that are starting to come off the sidelines and back into the market, because again, the single best investment a household can purchase is a home. You want to talk about the stats of people about net worth of individuals that own and rent?
Yeah, so I just posted this blog on my website, and it's about the dramatic impact of home ownership on your net worth. So there's a graph on there. I believe the graph we have says that the average renter has a net worth of about $10,000, and the average homeowner has a net worth of close to $400,000. I think it was a 40 times greater net worth just by owning a home. I mean, that's dramatic.
Yeah, that is. And think about this: 2/3 of the country's net worth is in home equity.
Yes.
So, and it's an expense that you're always going to have. Like, you're going to either pay rent or you're going to pay a mortgage. And if you're going to pay into something, you should might as well at least own it. And I look at it more of a sunk cost. Like, you have to have somewhere, you have to have shelter, you have to have somewhere to live. It's just a cost that you're always going to pay. Why wouldn't you be paying into something that's going to be worth more in 20 years than it was today.
So even if interest rates are high, you're still better off to make that purchase if you are in that
Think about
renting
it. We
situation.
just watched the interest rates were basically the highest they've been since, I don't know, over the last 20 years, and homes still increase in value.
Yeah.
That right there, and over the last, I think it's 80 years, only 4 years out of those 80 years, properties depreciated in value, and that was due to 2008, but it was completely different in 2008 because we had an abundance of supply and we didn't have enough demand. Now we have so much demand and not enough supply because a lot of the programs and products that were available in 2008 are not used today because they weren't used properly. Like we talked about, you used to be able to do a home equity line at 125% of appraised value when you moved into a home. So think about it like this. You'd move into a home, put 5% down, and then you'd be able to get a loan on 30% after closing. Yeah, that doesn't sound like you're borrowing over the home, but what that specific product was for the homeowner to be able to stick the money back into the property and renovate. I have so many homeowners that are like, hey, can we put something aside for windows, a new roof? That was a specific product to do that, to increase the value of the home and the livability of your home that hasn't been able to be.
Are those products even available now?
No.
Yeah.
The reason being is because what ended up happening is people would go on vacation, they'd spend the money, they didn't stick it back into the home, then you had a home that was still the same.
Undervalued now, really.
So that's why they stopped doing programs like that. But it was a specific product to be able to renovate your home without trying to do a renovation loan, like a 203K or a home style. The home style's through Fannie Mae and Freddie Mac. The 203K is an FHA. 203K, actually, VA and USDA both have them as well, but they're just so difficult to do because of all the regulations and requirements of that. This was that product was legitimately a way for people to be able to do the homes themselves, to do the work themselves, or act as the general contractor, and they could piece the project together, where those are just few and far between. That's why the fix and flips with investors are so big, because you borrow that money on hard money lines of credit, which is private lenders, which is not people aren't FDIC insured, and they're not regulated by the CFPB and stuff like that. It is legitimately an individual giving you the money. That's why the notes normally have to be paid back within 12 to 18 months, and there are a lot higher interest rates. But that's where the investors actually are able to really clean up, because those products aren't available for people that are purchasing primary residences, even though all the marketing material that you will read will say that you can do that. It's just the difficulty and the cost to do that becomes not feasible.
So you were talking about a little bit about first-time home buyers. I mean, because most people that own a home, if they've bought a home within the last few years, they kind of have some pretty good understanding, and they're probably not going to watch this video. Maybe there's some value here. Don't get me wrong, but of getting how we got to where we are. But you just mentioned USDA, VA loans, and FHA. Those are three pretty common. Well, VA is not necessarily a first-time buyer program at all.
And actually, FHA is not, and USDA is not. The biggest thing with USDA, you just can't own another home. Okay. Which is a no money down loan, but it's more for rural areas.
What do you mean by no money down?
There's a 0% down payment, okay? But then you still have closing costs. So if you could negotiate for some seller concessions, you could get into the property with very little cost. VA is set up the same way, but USDA is for more rural areas.
So rural, we're talking some outside of city.
Yeah, I would say outside of Allegheny County. You got your Butler, you got your Greene, you got your Washington, you got your Beaver. That's where Fayette, you want to be on the outskirts, because it goes off of population.
I think they have I think on their website you can actually type in a map and address. And
map comes up of the United States, type the address in it comes up green if it's approved, comes up red if it's not. VA doesn't need to be in a specific location, but you have to be a veteran and you have to have enough points to obtain a VA loan, so you would get a certificate of eligibility from the VA, and it would tell you if you qualify. Some people, if you were just in a reservist, and I'm not saying anything bad about that, but if you haven't generated enough points, you don't qualify for a VA loan. Okay. We just went through that with somebody. He was he thought he qualified for a VA loan, was in the National Guard for 8 years, but he never went active duty. Okay. So the active duty was what really helps you obtain a VA loan.
And VA is also, like USD, 100% finance, zero down. Now
Yeah.
there's closing costs.
Yes, there's still closing costs, and that's what I always want to get at is people always talk about, well, it's no money down. Well, you still have closing costs. The state and the county and the school district still want their money.
Taxes. It's taxes.
Yeah, they still want their money. It's not that you can't get away from doing that unless you get seller concessions, seller's assist, however you want to state that. And on a VA loan, you can get up to 4%. Or there's a caveat to that where the seller can cover all closing costs. And then on USDA and FHA, you can get 6%. So, and then FHA is also not a first-time home buyer product, but you just can only have one FHA loan open at one time.
Okay. So a lot of folks say, hey, I'm a first-time home buyer. What's available to me? What's that? Is there programs?
Yeah. Okay. So Fannie Mae and Freddie Mac have a first-time home buyer product, which is a federal product. One's called the Home Possible, one's called the Home Ready. It's a 3% down payment program with a discounted interest rate and discounted mortgage insurance. So basically, if you put 3% down, mortgage insurance is if you don't put 20% down, you have to pay it. It's called PMI, private mortgage insurance, where once you hit 20% equity, the mortgage insurance falls off the monthly payment.
So let's be clear, when we say mortgage insurance, it's not insurance for you. So it's insurance for the mortgage company.
Yes.
So that you're basically paying them a premium on top of your interest rate.
You actually don't pay the mortgage, you pay, it's in your monthly payment just like escrow.
Yes.
But there's like 4 main mortgage insurance companies in the country, and they're all federally regulated. They all basically relatively have the same rates because it's all regulated by the federal government. So if someone say they can get you a cheaper mortgage insurance quote, it's not going to happen because it's consistent through everybody due to fair lending. So it's basically goes off the risk of the file. So if you put 3% down and you qualify for one of those programs, the mortgage insurance goes off of like you put 10% down. So it's lower. That's the discount.
Okay.
And then you also get a little bit of a break in interest rate on those programs. But those are out there. There's a 3% down, conventional loans. And then people will talk about the down payment assistance loans and grant programs. There are grant programs out there, but please make sure that people are looking into those because a lot of the grant programs are down payment assistance loans. We have one for an FHA loan that's 100% financing. We will finance 3.5% on a second down payment assistance loan that's forgivable after 5 years.
Okay.
And you make no payments on that. It's just but if you refinance or sell the home within the first 5 years, you got to pay the money back.
So even if you refinance, you're going to have to pay it back.
But that's the same thing with PHFA, which is the state housing agency run through the state of Pennsylvania, which is a nonprofit. They do a lot of this down payment assistance loans and stuff, but their forgivable term is 10 years. If you refinance or pay off the loan within 10 years, you got to pay it back.
So are you seeing many people wanting to do that grant that's going to take 5 years for it to come up? Because
and the thing is, like you just said, it's a grant, but if you got to pay it back at some point, or if there's
what's the difference?
It's technically a loan. If there's any portion of that has to be paid back, even if it's a year, if it's 6 months, you have to pay it back. If you would sell the house or refi, it's
not a big deal, I guess.
It's not a big deal.
You need to know about it.
You need to know about it. You can't be misconstrued as a grant when it's really not.
Right.
That's what because I was watching the news last night and it came up, make sure to ask, they were talking about first-time home buyers, and they said make sure to ask about, are there any programs available? There are programs available, but the majority of them are down payment assistance loan. There also is the Neighborhood Works program that is in specific locations. There's some in Allegheny County. There's some in Lawrence County for like the Newcastle area and stuff like that to promote home ownership in some of the high rent areas where there's majority of renters. And what it is they'll give you up to $15,000 on a 10-year forgivable loan, which is basically a soft second mortgage. But at the end of the day, if you sell or refi within those 10 years, you have to pay it back. I always like people to understand that concept because I get it a lot where people are trying to refinance or they're selling the home and they don't even realize that there's a second lien attached to their property. And they're like, oh, well, I thought I only owed $145,000. Now I owe $150,000. But that is crucial for the real estate agent to know that because how they price the home. what they know with what you owe. And then if people, when they come in and try to purchase your home, are asking for seller's assist and all that, and then you have closing costs when you sell a home, making sure that you're positioning the property properly, because if there's another $10,000 that you have to make up, you might want to really make sure how you're pricing that property.
Yeah, you need to know what you have to work with if you're purchasing another one. I have had that happen where folks thought that was not a grant, or a grant as in forgiven already. Well, because my first house I bought in 2010, President Obama had I think it was a $10,000.
It was $8,000.
It
was $8,000. That was around 2008, 2009.
Yeah, 2009. Now you say it.
Yeah. Because so what you would do is if you were a first-time home buyer, on your taxes the following year, you would file, and they would give you it might have been up to 10,
9 or 10.
Yeah, it was $8,000 to $10,000 tax refund if you bought a home.
Real money.
Yeah, real money, because they were trying to promote people to purchase homes.
Yeah.
So, and that was real money. That was, you got $8,000 or $10,000 on top of your refund on your tax refund. That did not have to be paid back.
Yeah. I don't think there was any. Right, exactly. That was awesome.
That did not. I did the same thing.
Yeah.
That did not have to be paid back.
Yeah.
But that's the types of incentives that
probably are coming again.
I would hope that something along those lines would start coming again because of the sheer number of first-time home buyers we have looking out there. But here's the thing. In 2008, we had an abundance of supply. Yeah. They were trying to get more demand. Yeah. Right now, we have so much demand and not enough supply. So I'm thinking that a lot of those programs are going to have to go to new construction and affordability. Like we were talking with one of the state senators a couple weeks ago at the WGAR, and they were talking about just the permitting to do a new development. It takes like 3 years just to get the proper permits. Other places that are in the Midwest and the South, like in Alabama, that are pushing, it takes 3 months.
Yeah.
So we need to also petition some of our politicians to make it easier to do new construction and building with permitting, because the thing is if you tie that up for 3 years, think of the cost involved. It's very, very difficult to find and build a home between $250,000 and $350,000 for new construction. It's very hard. That's why you see a lot of the new constructions, you're over $500,000 because the cost just to purchase the land is a lot.
New construction is not affordable for the average
And
person.
That's what we really need to push, is we need to try to get affordable new construction for first-time home buyers.
And not even trying to mention anybody in particular, but Ryan Homes has had, I know they have a style of home, they call it Simply Ryan, which they oftentimes start their developments with that, I've seen.
Yes.
And they're just a more affordable home up front. So before, just to get.
And that's the biggest, that we need more of that.
Yeah.
And and honestly, Ryan Homes, for the most part for us, is like, we can't really compete with them because of all the building credits and everything like that. I'm just going to be transparent. But again, that home getting sold is another transaction 5-10 years down the road for us. That's what we need. We need to be building the pipeline of listings, pendings, we need to build the pipeline of more transactions. And the only way we're going to do that is through new construction. Mm-hmm. And you're seeing builder sentiment is increasing now with the outlook of their interest rates and everything like that. But it dropped really, really low at the end of 2023 because of how high the interest rates were and affordability. When you're talking somebody that is going to go under contract on a new build and it's going to take 8 to 12 months to build that, you quote them 6.5% at 8 months, and then you're quoting them 8% at the end. That's very, very difficult for someone. And qualifying for the loan as well, they might not qualify anymore for that house, even though you've already built it.
Yeah, absolutely. Kind of staying in that first-time home buyer. Also, I can't help but say it's a blog post on my website, but it's how to avoid common mistakes when you're in the process of buying a new home. And I'm just going to kind of shoot some of these at John here. So we put on here: don't deposit large sums of cash. When you're in the process, you maybe have a house under contract, or you're just getting ready to, right? Because so why would somebody not want to deposit large sums of cash?
Because, so in a real estate, in a mortgage transaction, all the money has to be sourced and verified where it came from, that it came from legitimate sources.
But it's my money. I can't put it in the bank?
I understand that, but there's no way to track cash. Okay. So I just had somebody go under contract, I believe 2 weeks ago, and he deposited he said, I deposited $63,000 in cash.
$63,000 in cash?
Like $63,000 in cash. I've been saving to do this, like excellent credit. He's just like, John, this is my accounting method. This is my accounting. This is how I save money. And it's like, I put it in a safe in my house, and I was like, I totally understand that, but there's no way for you saving that for the last 20 years for me to track that money where it came from. So we're now.
So what's the fear? So what?
The fear is that it's coming from like illegal activities.
Okay.
Because you just don't know, you can't verify where it's coming from. And I'm not saying that you are doing it.
And I've heard that maybe you think they did borrow it some source.
That's another big thing, is that they borrowed the money, or somebody borrowed the money to give to them, that they have a loan out there that's outstanding that we do not know about.
Okay.
Basically, it's called an unreportable liability. Basically, It's unreported. And there's some loans that you could obtain that do not report to the credit bureau.
Okay.
So if we don't find it, we don't know that, and it all comes down to the ability to repay. If that's going to affect the client to ability to repay that loan, you have to count it or you have to deny the loan. So the biggest thing is that it has to be documented where the money's coming from for down payment and cash to close. Any money that's being brought to closing or is involved in a real estate transaction needs to be documented. So if you're talking about gift money from parents or relatives, as soon as they give you that money, they became part of the real estate transaction. Okay. Even though they're not on the loan or anything like that, they gave you that money, they become part of the real estate transaction because it has to be documented where that money came from.
So what about we don't make any large purchases?
Reason why?
What's a large purchase first? Let's define that.
Here's another thing. Large purchases could dictate, do you make $50,000 a year or do you make $5 million a year? Okay, so a $75,000 car for somebody that makes $5 million a year is
not a large purchase.
Not a large purchase. Somebody that makes $40,000 a year that bought a $75,000 car is a very large purchase. Here's the thing about it. When we talk about large purchases, though, we're talking about taking out new credit lines. If you're saying, hey, John, I'm going to go buy all my furniture for the new home, but I'm just going to pay it out of my checking account, and I'll still have enough money to close, that's perfectly fine. It's that if you're like, well, I'm going to go get a no-interest credit line through Levin Furniture to buy all my furniture, that's a problem because that's another debt that's added into your debt to income.
Gotcha.
Not saying that you can't afford the home with getting that, but just make sure to bring it up to your loan officer or the financial institution that you're using. Pre-buying
appliances then, I guess, you know?
Yeah. You want to run that past, if you're paying for them with your checking account, but if you're getting a new credit line, that's
going to Lowe's and opening up something for your.
You have to make sure you're basically just disclosing it to the financial institution so they know. A lot of the times it's not a problem, but it's in our industry, everything is timing. People always ask, what's the right time to buy? When's the right time to sell? Well, when's the right time to take out a new credit line? When's the right, so timing of knowing what's going on a lot of the times is not a big deal. You just have to know. Like that gentleman that deposited that money, now we're switching to a different type of loan where he doesn't have to bring that much money. He's a veteran.
So if he wanted, in that situation, is there a point where he could have deposited that and then it would have been satisfactory? How long would it have had to sit in his account that's the right way of saying it?
Yeah, there are seasoning periods where it's normally the federal guideline is 2 months of bank statements. So if he deposited it 6 months ago, you wouldn't know. But if you're starting to look for a home and you want, when you're getting pre-approved, you might want to discuss that with your loan officer because they'll say, well, you need to get that money in the bank as soon as possible.
Okay.
And that's basically the federal guideline is 60 days.
So one of the common mistakes is people it says don't co-sign loans for anyone.
Because if you co-sign a loan for somebody, that's your debt.
You're on the hook for it. Yeah.
We just had it where we were doing we doing a real estate doing a mortgage, and the guy co-signed on a car loan for his dad.
He kind of forgets about it.
He didn't even think twice that was something that he shouldn't have done. What we did was removed him. We just kept it in his wife's name. Was fine. We were able to close and everything like that. But there's just those are the types of things that you have to be looking for. If you co-sign, you are still liable for that car, that liability, whatever it is.
So don't switch bank accounts.
Reason being is don't switch bank accounts because we have to document all your assets for the most recent 60 days. So if you're switching bank accounts, well, you don't have a history of that new bank account. There are ways around it, getting an opening letter and stuff like that, but it causes
slowdowns,
frustrations. It causes the buyer more work.
Yeah.
What we're trying to do, that there's enough documentation that you're going to have to provide. We're trying to limit how much you have to provide and trying to make the process go as smooth as possible. If you could just wait until after you close and switch bank accounts, it's a lot easier. Not saying that it can't be done, but again, sometimes less is more in a mortgage transaction, a real estate transaction, because there's a lot of moving parts. I believe when COVID happened, we were looking, and they dropped they dropped the Fed funds rate, and they started creating real estate transactions to stimulate the economy. The reason why they do that is because there's 25 to 27 different entities that get paid on a real estate transaction. You're talking all the tax base that's generated from a real estate transaction. So that's why when I'm saying watch what you're doing here is because there's a lot of stuff going in the background that you might not even know that is going to get you that home.
100%.
So that's why it's just limiting the things that you have to document.
So we're kind of hitting this one already, but it says don't apply for new credit.
That's the same thing of, don't make any large purchases.
Yep. Don't close any accounts. That's an interesting one. So why is this a mistake?
Well, when you close accounts, then you can't get documentation from them. Say, hypothetically, you close an account and that you had $17,000 in that account. You take that money and you put it in your new account. Well, if you close your account, it's going to be hard to document that $17,000 that just went into that checking or savings account. So that's the biggest thing. You want to keep the account open so you can get it documented.
When you close an account, are you aware, does that affect your credit in any way?
If you close like a credit card or something along those lines, yes, it could, because hypothetically, you got a Gap Visa card when you were like 22 years old because you like to shop at the Gap. Okay? All right, you had that. But maybe that credit line was reporting, and you're 40 years old now, and it's been reporting for 20 years. That might be your longest credit line. You don't want to close that account. You don't want to keep it paid off, but you don't want to close that account because that's strengthening your credit profile because it's showing that you have an on-time pay history for the last 20 years. So you want to make sure the types of accounts you're closing is how long was that history. Because I have a credit card that I got when I was 18 years old that I still have that I haven't used in probably, I couldn't tell you how long, but I always try to make 1 or 2 purchases on that, like once a year or every 6 months. Like my daughter likes the Oculus, so I buy her games on the Oculus, and it's like $10, and she buys one like very rarely, so I use that credit card. So, because if you don't do transactions on the credit line, they'll close it anyway. So that's what you have to look at, is how long have you had it open and how crucial it is to your credit score, is if it'll affect it or not.
So this is a little of a side question. So I recently, I got a call from a car dealership down in Virginia, and they said, hey, are you coming down to buy a car off us? I'm like, I'm not sure what you're talking about. He goes, yeah, I guess I didn't think so. That's why I'm calling you. Because somebody signed up with your credit to come down and buy a car. And I just looked it up because it seemed fishy, and so he called me. So I called all the credit bureaus and just basically shut my credit off.
To make sure, yeah.
And I haven't turned them back on. I haven't had any reason to. Is there any reason to let that just be shut off for?
Sometimes it's good to have a credit monitoring. A lot of credit cards nowadays have credit tracking. I will tell you this, more often than not, the credit score is not accurate. But if there's fluctuations in your credit score, like something happened, like a credit inquiry or a new bill, that's a great way to say, well, I didn't do anything, what changed? So that's credit monitoring, but locking your credit through like LifeLock or something, I don't know.
Just called each bureau.
Yeah.
Literally
it's not a bad thing. It's just when you do go to get
If I go to make a purchase, I can turn it back on.
Yeah, if you go to like try to get financing, you will have to turn it back on. But having your credit locked is not a bad thing though either. But also having like a credit monitoring thing on one of your like JP Morgan Chase, whatever credit card you have, is good to just look to see if anything changed. Mm-hmm. Check it once a month when you're paying your bill or something like that, just to see if anything changed. And nothing changed, normally nothing happened. So
for a while, this is some time ago, I wouldn't even look at my credit card statements that closely. But now I look at every one just to make sure, hey, and then they code them weird. Sometimes what is that? I don't even know what that is, you know? Like,
well, and that's the thing, is that you want to make sure you're taking an active interest in your credit is the big thing, is because a lot of people don't even know, but you still, it's not saying that you care what your credit score is, it's just making sure. Because with us going more to a digital system with our financial, everyone has an app and all this, you want to make sure, because it is very, very easy to commit fraud on that. Like when people are trying to hack your accounts and your credit cards and stuff like that. Now, financial fraud is a very big deal.
Yeah, we should probably get some kind of a sponsor for this. That way we can, quote somebody there, huh? So, if there's any changes in your financial status, in your work status, any of that, that needs to be discussed with your lender.
Yes, and you want to do that. It's not that your lender's overall objective is to get you the home, get you the money to buy the home. They're not there to tell you to be like, oh, they're there to advise you on what's the best way of practice. So giving them the information and telling them what you're trying to accomplish and what you're doing is trying to keep an open dialogue with your lender. That's the types of lenders that you should be dealing with. You should deal with somebody that you feel comfortable talking to as on just a regular level. Like sometimes when you don't feel comfortable talking to your lender, it's not the lender you should be using. I don't care what the interest rate is or the closing costs and all this. If you don't feel comfortable disclosing things to them, it's probably not the lender you should be going with. Mm-hmm. You shouldn't hide things from them, because at the end of the day, they are working for you.
Yeah, I mean, in real estate, we're a fiduciary, right?
Yes.
And so I'm here putting their interests ahead of my own interests and ahead of anybody else. I've got to give them the advice and recommendations that I would give to my mother, my grandmother, anybody that I would.
100%. That's what the whole thing with coming out with the down payment assistance loans, the grant programs, making sure that, that those are out, like making sure people are understanding what they're getting into. And these are large financial transactions, making sure they know the severity of what they're getting into, and being able to be comfortable and that your lender's being transparent about what's all going on and what's all involved. Sometimes people say we're telling them too much because it's like over their head, but we're like, we just want you to know. So if somebody says something, you at least know. Mm-hmm. Like you're like, okay, yeah, I've heard that. It's kind of, because obviously the average homeowner purchases 4 to 5 homes in their lifetime. We're not asking you to be experts, but we're just trying to get, especially first-time home buyers, we're trying to give you something to hang on to on your next transaction too. So you kind of know what to look for, know what to prepare for, and stuff like that. Mm-hmm. And we're not expecting you to be an expert at all. That's what we're here to do, to provide you with.
So let's just give what do we think is going to happen in the next, this is January 24, like the next few months, it's going to, rates are going to come down, just, soften.
Yeah, I think that 2024 is definitely going to be better than 2023. I think it'll be better than 2022. I don't think it's going to be as good as 21 or 20.
Yeah.
But I think
those were unicorn years,
yes,
right?
Yeah, but I think that we're going to see a lot of growth in our business, and we're going to see us getting back to a healthier transaction levels with listings and all that, because I think that people now are just understanding what real estate is, if that makes any sense, because we have been such a topic on all on a national scale of all the news we've been on. I mean, I think they've talked about interest rates more than I talked about interest rates on the news and stuff, in the basically home prices and all that. We've been on the news, I swear, like every day. Mm-hmm. So I think people are more knowledgeable and understanding about what they're getting into now. So I think that's going to help them moving forward as well when they're looking at purchasing a home. And I don't think people are as worried, because there was a census, like an economic thing that was done with consumers, and this report was being done since 2010. First time ever that the general consensus is that interest rates will come down.
Okay.
So people actually are knowledgeable about what's going to happen.
Yeah.
So that's normally people are like, I don't know what's going to happen, but now people are actually knowledgeable, knowing, so that it's getting out there that the interest rates are going to become. People think that interest rates will be lower in 2024 than they were in 2023, which is good for buyer and seller settlement.
And so I have conversations, multiples every day about, everybody, hey Nick, when should I list my house next? There's pent up demand. There's over 20% less homes sold in 23 than 22, let alone probably 30 or 35% less than 20 and 21, right?
Yeah, exactly.
So there's pent up demand. It's gonna come, all of a sudden everybody's gonna get the same idea. It's funny, there's weeks and months in the year where everybody gets the same idea and your phone blows up and everybody wants to buy a house this week. And that's great. But, there's a season coming and, if you can look here, this is a little chart I'm going to show you. I circled, this is how many homes sold in June. You can see only 2 times going back the last 5 years. June has been the highest amount of homes have sold in the whole year. And it's not like some astronomical number oftentimes, but in June, there's a couple of these in July.
It is normally the highest number,
yes.
is June.
But those homes, that's why it's important. So if you want to sell your house, those homes had to come on the market how long does a transaction take? 30 days?
30 to 45 to 60 days, depending on timing.
Yes.
Like we talked about timing before, so you would probably have to list your house in March.
Right.
March, maybe end of February.
Yes.
So, but then you probably should start in January to prepare it.
Yes. So it might be now. Get ready. Right?
Yeah.
This is legitimate information, and the highest price, the highest average home price is always in that June and July market too.
And it makes sense because think about it. People are getting out of school, a lot of people move for school district, so they're trying to buy and sell in that particular time because they want to make sure that they're in the new school district in August. So, and it has really nothing here in the north. Obviously, it's because of winter too, is why you see June and July. But even in the south and where it doesn't get that cold and stuff, it's still those are the months.
Yeah.
Because a lot of it has to do with schooling.
Mm-hmm. And interest rates are normally, so if you're a buyer, again, I think February and March, probably early March, because rates probably in past general years, they start to bump them up in that spring market, right?
See that's nice that you say that because honestly, there's no economic data, there's no financial data on this, but it's just weird in the slow times that it seems like you get a little bit favorable interest rates at those times than in the peak months of the year, which is...
It's supply and demand, maybe? I don't know.
I honestly, and less transactions are happening, so those transactions are more crucial to get. So you're making sure that on the second, the people that are purchasing the mortgage-backed securities on the secondary market are getting enough to build their pipelines, so they might get a little bit more competitive in those and take a little bit, we call it a haircut, in profit to make sure they're at least getting the transactions in those slower months.
Yeah. I always said when I sell my house, I sell it in February because it's, there's a lot of demand still, and everybody wants their house. Well, my house looks really pretty with the flowers out. Yeah, but let somebody else take care of the flowers. It's kind of what I always say. Let's just sell when in February with snow on the ground and everything looks pretty, and and you don't have to worry about cutting the grass or any of that. It actually makes it a little easier on you. But
and landscaping is big in the summer months. And you'll be surprised. And I'm not an appraiser, but if you have a well manicured lawn, when an appraiser comes in, it just makes it look cleaner.
Everybody's influenced by things.
It has nothing. And really, it has nothing to do with the value of the home or anything like that. It just sets the stage for when the inspector's coming in, the appraiser's coming in.
Those first impressions in everything matter.
Yeah.
So hopefully we put a first impression. But I don't know. Do you have anything else you want to add?
No, I just want to look at 2024 is outlook is going to be a really good, productive year. I think 2025 is going to be even better, but we're starting to get on that upward swing of the curve. And I think it's going to be really, really interesting. And there's going to be a lot of activity with first-time home buyers, because I really think that they're going to start getting off because affordability is going to be coming back in line.
Yeah. I mean, I could probably sit here and talk for another hour or two about different things, because it's an election year and stuff, and those are always fun times too. So,
yeah.
But
I don't even like to get into that,
yeah.
because it's because that changes.
Yeah, for sure.
Yeah, and it changes with and as we see, when there's visions that are set by like the Federal Reserve and the outlook and all that, they can dictate a lot.
Yeah.
So what I want to look at is things that they can't dictate, and that's, affordability. Well, they can dictate that, but what's coming back in line is affordability and interest rates. So the overall perception of everything is going to get back in line, but the election definitely, because of the types of assistance stuff that you're talking about, the tax refund credit, I'm really hoping to see like some builder products to help builders get new construction out there. So it's like you said, the election can dictate some of that because of the policies that will be in place.
Yeah, cool. Grateful for your time. This is John Kearney, Victorian Finance, and I'm Nick Supik, Century 21, and just grateful for you guys to check us out and share this with somebody. Maybe they are looking to buy a house and they're just trying to figure out how to navigate that. And so as we finish, Hebrews 3:4 says, every house is built by someone, but God's the builder of everything. So grateful for your time. Have a blessed day.